Exactly. And the big story in the market today is interest rates, right? I
Yeah.
think most people have an idea, what rising interest rates mean, costing them more to borrow money. One of the reasons I was hoping we could talk was like, so you could, again, put in layman's terms, right? It's like The Office, like Michael Scott, like
Yeah.
explained to me, like I'm like a 5-year-old,
Gotcha.
like, how interest rates are determined.
So rates in the mortgage marketplace are determined by the bond market. And what's happening right now in the bond market with inflation being what it is the bond market's chasing inflation. And what I mean by that is you don't want to hold bonds if you're an investor that have a low return, because if your low return's below inflation and you think that inflation's sticking around, you're losing money yearly, right? If inflation's 7% year over year and you have a bond that gives you 3%, you're losing 4% technically.
In real terms.
In
correct.
real terms, right?
Yeah.
So your growth from an institutional investor standpoint, you're not hitting your quotas, right? So what's happening and I think a lot of people get not confused, but just have the misunderstanding that when the government comes out or the Fed comes out and says, hey, we're going to raise rates, that automatically raises mortgage rates. It does as a correlation, but not a direct cause and effect. So
right.
The Fed moving their
I'm glad
rate,
you're getting into this. Yeah. Like the Fed funds rate.
Prime rate. Prime rate's overnight lending between banks, which when overnight lending between banks goes up, then banks start adjusting HELOCs, short-term financing, right? So it does ripple into some piece of mortgages, which is a home equity line of credit, which is a mortgage, but it is more like a credit card. So it gets treated more like a credit card from a bank standpoint, but it doesn't make its way over to the mortgage-backed security market. That's the biggest impact to rates. And the mortgage-backed security market moves more based on the fundamental reason why rates are going up. Rates are going up right now because of inflation. So the Fed's trying to cool inflation, and the way they cool inflation is they're trying to slow down spending. And if they slow down spending, they can cool inflation. So if they can get people to spend less, buy less, they have less dollars chasing less goods, then we get inflation to cool. Right now, we have a lot of dollars chasing a scarce amount of goods. We have supply chain issues, and we have all this money that's been pumped into the economy. That's perfect combination for inflation, right? Like 1 + 1 = 2. Like that, a lot of people saw this coming, and it's not news to most people in the mortgage world or financial world that rates are up and that mortgage rates are up, because inflation was kind of this thing that was looming the entire time of COVID. There's a lot of forecasters saying that, hey, with the stimulus and with supply chain issues, we're going to have inflation, right? So what's happening is that bond market is now changing to adapt to the inflation to get higher returns. So then what happens when that bond market's chasing what's called in the market higher coupon returns? So they're buying mortgage bonds that have higher interest rates. Lenders now need to offer loans with higher interest rates because that's where the market is. So if I, as a lender, offer you a 3% interest rate, I can either keep that loan at 3%, I can wait for your money to come back, but I wouldn't be a prudent financial person if I knew inflation was 7%.
Right.
Because I'd actually be losing money on the loan I gave you this year.
Yeah,
right?
Exactly. And just to jump in, like we talk about this a little bit just in the housing market too, right? So, we've experienced this sort of like rapid devaluation of the dollar. And when I was saying earlier, like we're in an asset economy, like the full explanation of that as it pertains to housing is like, sure. So like we have like 16% like year over year appreciation around. Like it's absolutely crazy. But in the face of like inflation, it's really what, like 5 or 6%, like, so like in real terms, right? When we say like in real terms. So that's sort of the, kind of comparing, inflation with the market, that's one thing that I'm talking about with people a lot. And I know, and I hope I didn't cut you off, but
no.
I guess one thing I did want to get to was just, sort of like the general advice for the real estate consumer or whatever. Like when interest rates go down, I think people understand the incentives to refinance, right?
Mm-hmm.
Get like what you're saying, like a home equity line of credit, to buy a home or a car or to transfer any high interest debt. When interest rates go up, right, and we're battening down the hatches here. So what are the right moves to make from like a personal finance perspective?
So this has always been my mantra, and something that was taught to me by my dad was live within your own economy, right? So it all circles back to that previous conversation we just had about what I'm talking about with clients, which is, buy the house you can afford. And I think that, so I just did a like kind of high level what's happening with rates. And I think any normal, I don't say normal, but Joe Schmo home buyer right now is sitting there like, dude, I just want to know what my rate is and how much is my payment, right? Mm-hmm. Like, I don't care. Like, most of that, I think, really goes over the head of a lot of people, where it's like, we don't care what's causing the rates. We just want to know that, what my payment is, right? And we just know that my payment's higher now for the same priced house than it was 3 months ago, right? Like, that's the consumer impact now. I don't think most people care what causes the rate, right? If that makes sense, because we can't change it, right? There's nothing, I know what causes it. I can't like call someone and be like, hey, can you really lower these rates? This is hurting a lot of people. Right? Yeah. Like, there's nothing we could do about it other than it is what it is type of thing, which always circles back to just buy the house you can afford, right? Like, if you're a buyer right now and you're pre-approved for $500,000 and you rerun your numbers with your loan officer and you realize that a $500,000 house with new interest rate environments, a little bit too much, salt on your steak, and you really don't want to do that, go down to a $450,000 house, right? Maybe that moves you to a different town. Maybe that prices you out a little bit. Maybe it doesn't. Maybe you can come up with a creative way and do an adjustable rate mortgage for 7 years, get a little riskier. Whatever it is, still try to buy that house within your own economy. And, you kind of have to, unfortunately, deal with what we're given from that standpoint. I still recommend owning, because right next to that, rent's gone up 20% year over year or something like that, right? Like, I think the rent number was something ridiculous
it's crazy. Yeah.
Because everything's getting more expensive for the consumer.
Yeah, it's like 18, 19%. Yeah. Hey, it's actually higher than, the rent inflation. Yeah. Sorry to cut you off. It is actually like higher than, I think, the appreciation of like property value. Yeah. You know what I mean? Like, yeah.
And that's basic economics. And what I mean by that is the landlord's a consumer too.
Yeah.
So now the landlord has to pay for all this maintenance on the property. Taxes are going up. Insurance is going up. All of these costs are going up. They're trying to turn a profit. So those costs actually go up more. So
passed on.
Yeah. If a plumber now is more expensive to call on the weekend to fix your toilet, as
much more expensive.
Yeah. You gotta up your rent, right? We're not, the sad part about capitalism, I think, in the US sometimes is that it's this terrible notion that we're all out here to make profit. Profit is a shared value that we all see amongst each other, right? And what I mean by that is when profit's something that we all deem as a positive, which is profit is 1 + 1 = 3, which means that I'm giving you some form of service that you deem as valuable. You're paying me in return. And the reason why I get to 3 and not 2 is because then what you're paying me in return, because you deem so much value out of it, I get a little bit extra, which then allows me to go buy other services and goods. And that math just keeps going on and perpetuating. And we're all happy with the service we're providing for each other, right? That's really what profit should entail. Like, the downfall sometimes is, the greedy corporations and all of that goes along with it. But it's just bound to happen. So if, as a home buyer, it's more expensive now because of rates. It's more expensive now because inflation, from the standpoint of heating oil, is more money. All these things are more money. It's even more of a reason to buy than it is to rent. Yeah. So try all of your absolute avenues possible to buy. Even if you think the market's going to completely collapse next year, you can't time it right. There's no way to time it, right? People that thought the market was going to crash 3 years ago are sitting here like, oh, well, that was not a good move. Probably should have bought that house. Been renting now for 3 years, and we just burned $90,000 that we'll never get back because we rented for 3 years.